Thai Silicon Valley and I'm one of the founding members of Thai. I'm not too sure how many of you are new to Thai here in this room today. Can we have a show of hands? How many new to Thai? Oh, just three. So that'll be easy then. So just a very brief introduction about Thai. Thai was started right here in Silicon Valley 19 years ago by entrepreneurs for entrepreneurs, and these are the people who are highly successful people as entrepreneurs who came from primarily from South Asian country like India in particular and Pakistan and the like. And they had come to America, in the 60s and 70s, and they had succeeded in their business, as well as in corporate world, and some of them even academia. And they said, gee, won't that be nice, if we can form a society and help anybody who wants to be an entrepreneur. And that's how we all started, with the sole mission to promote entrepreneurship and to basically genuinely help anybody who wants to be an entrepreneur. And we're very proud to say that in our short 19 years history, this organization has grown to be a highly successful organization. And Silicon Valley is the mothership, but we are now into 13 countries, 57 cities. But our major strength is still across US-India corridor. 80% of our chapters are located in the US and India. In the US, if you name a major city with a sports team, chances are Thai has a chapter. So it's very easy to remember that way. So you think of Seattle, or you think of Dallas or Chicago or Boston or wherever. Okay, we are there. Okay, so the sole mission of Thai again is to foster entrepreneurship, and the core constituency of Thai is what we call the charter members. So these are the people who are successful people as entrepreneurs or executives or even members of academia, and they get invited to join Thai. So you just cannot just apply to Thai, say I just want to be a charter member. You have to be invited. We got a process that is applied through every chapter. People get investigated that, yes, are they really successful? Most people are successful, who are considered, but a lot of people are not quite ready and willing to give back. So they won't qualify if they're not ready and willing to give back. So that's the criteria we use. You got to be successful, and you got to be at your point in your life that you genuinely want to help others. Many of our charter members here are in this room today, and I want to thank them all. The other constituency of Thai is what we call our general member and entrepreneurs. So these are the people who really are either aspiring to be entrepreneurs, or maybe they already are, but they need some support and some guidance from us. So the core member, which is the Thai charter members, so they attract the entrepreneurs around them. And then the outer periphery is all the people who we call sponsors. So these are our venture capitalists, major corporations, law firms, accounting firms, because they want to hang out with this crowd. And that is the core of Thai that as we say. And what we do, we basically share a lot of intellectual capital. And we're all volunteers. I'm a volunteer president, and so are all the charter members, and so are everybody else. We all have a very, very small staff. Silicon Valley has a small staff, like 5 people, head by executive director, Kiran Malhotra, and we got Patricia, who's over here, you must have seen around. She's one of the program support managers, and we have 3 other with her. So it's a very small staff, and it's all volunteer-led and volunteer-supported organization, and that's what really makes us so unique, that we are really an organization of individuals. We are not a trade association, we're not a corporate body, and so this is very important. Okay, so a charter member could be with one company today and could be with another company tomorrow, but that charter member still is a Thai member. So this is very, very important, and that's why we are so unique. And in short, 19 years, we've become now the world's largest organization for entrepreneurs. So we do a lot of programs, and programs are basically 2 types. So one is the program that basically caters to entrepreneurs. So how to start a company, how to grow a company, how to, and how to have successful exits. So those are kind of cater toward that. And the second set of programs are all industry specifics. And each geography, each chapter has, based on its own economy, so they will do program specific to the sector. Silicon Valley, since we are very heavily into tech, so all our programs are geared toward tech. And even the tech we have now, we focus on 5 sectors right now. So we have social, mobile, cloud, energy, and life sciences. And that's also, you see a lot of programs, designed around that. All said, we do more than 50 such programs year round. And then we do our grand convention, which is called TaiCon, happens every year, and that is our grand convention. The thing to say, if you take a look at last 3 years, for example, we have had 25,000 people have attended and and participate in our program. That's huge. Okay, so this is a very very unique again phenomenon. I don't think any other organization has that level of mass, and this is just in Silicon Valley alone. And we got programs across all the other chapters. So we certainly would like you to welcome those of you who are already within the TIE family, but especially to the three people who raised their hand the first time they're here. So I welcome you all. And with that, let me introduce you to Shali Jain, who is the chair for this program. And the background of this program was that we looked at our entrepreneur base and we really realized that we have a lot of people who have been successful entrepreneurs. So they came to TIE, they learned the tools of the trade, how to start a company, how to get funded, but they are faced with a growth issue. So we designed a specific program and we call it a Growth Company Forum. So that's why you see the audience size is slightly smaller here, because the people who are in the growth stage, we have fewer number of people, but we have a lot of people who are just working at Cisco or Intel or Google and say, I want to start a company. So we have a lot of programs, and you see hundreds and plus people show up for those kind of stuff, aspiring entrepreneurs. But those of you who are in this room, that means you are really faced with the growth issue of the company, and that's what we did. So we started this a little over 2 years ago, and Shali the chair. And actually we have a co-chair also for it, and who is Shailesh Shukla. I just want to recognize Shailesh, and I'm going to call Shali on the stage. Shailesh is a general manager at Cisco, and he has graciously agreed to kind of come forward and lend a hand. But the overall program is guided by Naveen Bisht, who is in the audience. He's also a board member, so a board person kind of has the overall direction and guidance for the programs. So I want to just welcome, thank Naveen for doing this work. So I think so Shali is going to come and now give more background about this program, how this one came about and how we got wonderful panelists put together. I think and the topic is highly timely. So Shali, would you please come on over and just take it away and introduce your panel and thanks. Thank you. Okay.
Thanks, Vish. Good afternoon, guys. My name is Shailendra Jain, and thanks for the introduction, Vish. While we wait for the panelists, let me give you a quick background on who we are, what GCF is all about. So about a couple of years ago, about 2009, Vish and Shankar and a couple of the board members, they've been always discussing how early stage companies, once they graduate from TIE, there is not an ongoing relationship with TIE. Right? They go on to run mid to late stage companies, mid to late stage companies. So what happens with our relationship at that stage? So the entire forum was started with an idea to discuss and create programs and inspiration for entrepreneurs. Please welcome the panelists. I'll just hold up while they sit up. So the entire program was created with an idea to create content, inspiration, networking opportunities, a forum for service providers and sponsors to get together that addresses topics that are not typically covered in an early stage discussion, right? So you heard, I think, yeah, that's Kevin. Welcome, Kevin. I know you're just in time. I think you were 10 minutes holding off just for you. Wish took 10 minutes to get you enough time to come up here. So the whole idea was to create programs, whether it be, how to prepare for public listing, how to do a roll-up strategy with private equity guys, how to address governance and compliance issues at the board level. These are issues that you as companies in the early stage typically never have to fend off. But as you grow in your company's growth state, towards your company's growth state, you start to need advice and networking and service providers' help to address these issues. So with that in mind, we've done about 4 events a year, about 3 to 4 events a year. Events have gone in to discuss reverse mergers. We've done case studies, $100 million exit for Mimosa, that case studies, which Vish again is familiar with. We've done a pretty interesting case study of 3PAR, which was about last year with, again, Vish's help, which discussed an insider's perspective on how HP and Dell did this whole bidding war for the company. So we've also discussed Asian executives in board level, how they fare at Fortune 500 companies. How are they faring compared to the traditional impression in the marketplace as Asian executives have arrived? Is the data actually showing us that trend? Right? So you have these kinds of discussions that are typically fascinating for executives like yourself. So along those lines, and I'm missing Mona's bio, so I'm going to rattle off what I remember. Along those lines, I'm going to to quickly introduce the panel and take my time to introduce Mona. Today's panel is going to be about IPO, the state of the IPO market. But besides that, which is all about growth capital for companies, what's the state of the private share market, the so-called shares post and second market in the space today? Does that provide companies with the liquidity option, the growth capital that's required, or do you still have to prep for an IPO market, the public listing market? And it's going to be a fascinating discussion because Mona herself comes from that space. She has had an exit in 2009 called Inside Venture, is that right? So most of her companies are called Venture something, so I think I have an easier time remembering this. But she had an exit in 2009 when she sold her company, the shares, to Second Market. Currently, she's the CEO, founder of Liquidity, which, let me give you a little bit of a background. Mona comes from corp dev and investor relations background. So all her ventures have typically focused on funding and how to do better job at doing investor relations, right? I mean, and I'm kind of embellishing a little bit, but...
Right, so most of it in-house companies like yours.
Right.
And develop this for you.
So Equity has, or is, the charter of Equity ends up being focused on institutional buyers and funders and their relationship with growth stage companies and how that is an essential part of whether liquidity options or IPO listing or even just generally good, healthy investor relations. So that's the charter for Equity. She has been recognized as a Women of Renown by San Jose Business Journal in 2010. She was a speaker at TICON. I'm rattling off from memory, so forgive me if I'm missing something. So she's been recognized. She was at TICON. She was a speaker at one of our panels. She has been an adjunct professor at Johns Hopkins, I believe, in the Engineering School of Engineering. She has done 4 IPOs in the capacity of corp dev / public relations. And I think with that, I know Mona will probably talk a little bit about her background more as she presents the slides, but the format for today's discussion will be a few slides from Mona, which will set out the context. And then we'll go into a great discussion with the panelists, and I'll let Mona introduce the panelists. Most of them are here, I don't think we're missing anybody. So with that, Mona, please welcome Mona. And one more thing, sorry guys, before I forget. Thanks a lot to Bill Shaw and Naveen and everybody to help put this thing together. It was a last minute thing, and we appreciate that. Thanks.
Thank you all for having us here, and I'm delighted that you all are entertaining the subject tonight because it's really confusing. So now, having been fundraising for my second company in this space, it's pretty incredible how few people really understand how the space works. So I'm thrilled that Ty has attracted such an incredibly talented panel for us here. So we're going to get to see many, many perspectives on the IPO market, what's working, what's not working. It's really been confusing here. It's shifting the way the venture capital industry, how the entire industry can work, because IPOs are integral to the entire venture industry. And now with the new private shares markets, we read a lot about them in the press, but still it's a little confusing, and we hear a lot about Facebook and Twitter, but we're not really reading about the names of our companies. So how can we make those work for us? And so we have a terrific panel who I'd like to introduce tonight. And so first to my left is Craig Harding. Craig is the CEO of ZipCourt, an online dispute resolution system that is a significant improvement over litigation, mediation, and negotiated settlements. And Craig previously served as the general counsel and secretary of Tesla Motors from 2006 to 2011, and so that we met a few years ago when he was in that capacity. And he handled the legal affairs for the company during its growth from 60 employees to over 1,000 employees, and was there also helping manage Tesla's IPO for the company. Prior to Tesla, Craig was general counsel and secretary at Metrio Inc., Intershop Communications, Kaleida Labs, which was a joint venture of Apple and IBM, and Actra Systems, a joint venture of Netscape and General Electric. Craig has also completed numerous ultra marathons. I didn't know that about you, Craig, including the Western States Endurance Run, 100 miles. I know you're a yogi like I am, so that's the other side of that. So he's strong and flexible. And Craig has a BA in mathematics from Duke University. We're both Blue Devils. And JD from Vanderbilt University School of Law. So please welcome Craig tonight for us. And
at one time I worked for Vishra. I was walking in here.
So one of the best resumes, incredible companies that you work for. So thank you for being here. And Craig is going to help share, the inside scoop on IPOs and some of the secondary market activities that he was involved in as an operations person. So Glenn joins us as a partner from GGV Capital, and Glenn, joined GGV as a partner in the Menlo Park office in 2006, and he's led GGV's investments in Pandora, Conviva, Focus, SuccessFactors, Isilon, and Quinn Street, and helping the latter three through their IPO offering process. He's also actively involved with GGV's investments in Aperio, and forgive me if I mispronounce some of these, Blue Kai, Buddy Media, and China Talent Group, CTG, as well as new investments in software as a service, and cloud infrastructure, online marketing and advertising, and human resources technologies. So very hot areas. Prior to GGV, Glenn was a general partner with Partech International. As head of the software and internet group, he led successful investments in broad-based software, acquired by Cana, Data Center Technologies, acquired by Veritas Symantec, Digital Island, acquired by Cable and Wireless, Pentasafe, acquired by NetIQ, and Vignette, which went public on the NASDAQ. Earlier in his career, Glenn worked with Goldman Sachs and also with SPO Partners, a San Francisco-based private investment partnership. Glenn has his BA from Stanford, where he started on 3 NCAA championship tennis teams, and also has an MBA from Stanford, where he was an R.J. Miller Scholar. He co-founded and remains active with the Spotlight Foundation, a nonprofit organization that for the past 14 years has been dedicated to funding social entrepreneurs, addressing the educational needs of at-risk youth. Wonderful. And he's also my hero. His firm has been involved in 9 IPOs in the last 18 months. Did I quote that properly? Which I think is a miracle in the record. So real expert. Give us a lot of great information on IPOs. So thank you for welcoming Glenn for us. Michael Guthrie is Senior Vice President Business Development at SharesPost. Mike joined SharesPost as SVP, as Senior Vice President in 2011 to help build out a liquid capital market for private companies seeking to raise primary capital and provide secondary liquidity for existing shareholders. And so this is one of the newest forms of finding capital for late-stage companies. That's the topic tonight. Mike has been advising and investing in private and public technology companies for over 20 years. He started his career on Wall Street at Montgomery Securities and Credit Suisse First Boston, where he helped companies such as JDS, Uniphase, Broadcom, RF Micro Devices, OpenWave, and SGI raise billions of dollars in private and public capital. Those are all some, very big names and big deals. After leaving banking, Mike ran a private investment fund for mutual fund giant J&W Seligman, and in 2000 was a co-founding partner of TPG Ventures, the venture capital arm of TPG Capital. His investment experience extends to middle market technology buyouts as well. As an investor, Mike has backed companies such as Quinn Street, Optium, and subsequent, that went public on the NASDAQ as well, and was a subsequent sale to Finisar, I guess post-IPO. Blade Network Technologies, which was a spin-out from Nortel, and subsequently was sold to IBM. Wise, did I say that properly? A spin-out from Smart Technology Holdings, and Ingress, a spin-out from CA Inc. So you have to forgive me, I came from the East Coast 3 years ago, so I have a different database also of some of these companies. Mike holds a BA in economics from University of Virginia, so we won't hold that against you, any of the Blue Devils here on the panel, and an MBA from the Stanford Graduate School of Business. So thank you for welcoming Mike being here with us this evening. Next on our panel is Sender Salakamar. And he's, I hope I didn't butcher that too badly, as formerly Mona Tapazara Elderfraui, I empathize. He's a vice president with Morgan Stanley, Smith Barney. And Sender currently serves as vice president in the investment banking group based in Menlo Park, California. He focuses on providing strategic advisory and financing services to leading private and public technology companies, focused particularly on software and cloud or software as a service companies. Sender and his team have had the privilege to work with category-defining companies spanning several segments of technology, including Tesla, McAfee, Micron, and Fortinet. So far in 2011, Sender and team helped lead the IPOs for ServiceSource and Responsys in March and April respectively. Prior to investment banking, Sender spent nearly 8 years in the technology industry across engineering, product marketing, and sales. Sender holds a BS in computer science from the University of California, San Diego, and an MBA from Cornell University. So thank you for joining us, and we're really happy. And Kevin, thank you for being here. I know you must have had a very busy day, too. Kevin's with the NASDAQ, where all 4 of my companies that I worked for in the 90s. So I spent 10 years serving NASDAQ-traded companies in the 90s, so I knew your market well. And Kevin is the Managing Director, Global Corporate Client Group at the NASDAQ. And he is responsible for working with private companies in the western region of the US. Kevin works with early-stage companies by providing insight into the capital markets environment, the process involved in taking a company public, and assisting private company management teams via value-added products and services. So if you're considering an IPO in the next couple of years, you'll be talking to Kevin at some point. Kevin has over 20 years of experience within the financial services industry, having spent the last 5 at the NASDAQ. And prior to that, he spent 5 years as a senior vice president at UBS, and before that, 3 years as a vice president at Robertson Stephens, one of our former four horsemen, investment banking firms. Kevin started his career with Bear Stearns, and he received his BA from St. John's University. So, welcome our last but not least. So, we have an incredible team here, and hopefully between all of us we can help explain some of the confusion in what's been going on at the capital markets. And so one slide, I borrowed this from David Wield, who was a former vice chair of the NASDAQ markets, and he also served on my board with my prior company. And David's really great with helping use statistics to create pictures. And so what David tried to show, people blame Sarbanes-Oxley and regulations, and they blame the internet bubble for really taking out the IPOs. But if you look at the slide carefully, the orange part of the bars is IPO deals in 50 million and over category versus the blue part, which is deals under 50 million. And so what that helps to visualize for us is that even before, the bubble years or from the very beginning, what you notice, there's still IPOs happening, but the orange bar is increasing at a dramatically faster rate than the rest of the statistics are shifting. So even though, the bar is at a higher level, the blue part of the bar, the smaller deal size, is dropping dramatically fast. So something was happening in those years, and maybe some of our panelists can help explain why. But David Wield writes a lot on this topic. His stuff is available on the internet. And his thesis is that with decimalization electronic trading, the volume and velocity of trading increased so quickly. And many factors kind of happened all at once. And the larger deal sizes were showing up even before the internet bubble crashed. So people point to that and say, oh, only the biggest companies like Facebook and Twitter, can come out now because because of the dynamics of needing a larger deal, or because Sarbox and all these things. But no, it was actually happening long before Sarbox, and it was happening long before the internet bubble came and created a lot of risk aversion and fear. So deal size isn't related to the bubble. It was actually happening before that. So that's a phenomenon we can look at. And does someone have the remote to go to the next slide?
Keyboard comes up.
Oh. Hidden keyboard. Okay, so why do small IPOs matter? Because look at all the great companies and the jobs they've created today that were all small IPOs. So Amazon, 33,700 jobs at the bottom. Starbucks was one small IPO, only 32 million deal size in 1992. It was 140,000 jobs there. Oracle, with over 100,000 jobs, came out at a 32 million deal size. So do you see IPOs in this range at all today, Sender? No. And even some of the bigger ones have trouble making it to market. And why is that? And is there something we can do about it? I feel the answer is yes, and we'll see what the rest of our panelists have to say. So the fact that the small ones started to disappear is important. So what's important also to realize is that IPOs are integral to the venture capital industry. Most venture funds are not evergreen, where the money keeps recycling. They have a beginning and they have an end. So they need to, usually there's 7 to 10-year funds. There's a few unique ones that go 12 years and up to 15 with extensions. but they need to have exits in order to work. And so if you look at the amount of capital that was raised, that also changes the dynamic. When you have very, very large funds, you can't do $1 to $3 million deals anymore. You'd have to, hire so many more people to do it. So the deal sizes also increased. So perhaps part of the dynamic of larger IPOs was related to the fact that, through its own success, the venture industry, started investing at larger deal sizes and creating more success. So all these things kind of begin to factor in together. But if you look at, see how much money has been invested in, we certainly haven't created, IPOs to even come close to exiting these funds that have come in. So even though we've created great companies and created lots of jobs, they haven't necessarily exited. So these numbers are not included in the S&P 500 or the Dow Jones Industrial Average, which are public funds. So this is invisible. So a lot of the lack of economic growth is actually stuck here at a private level. It's actually there. It's just not necessarily visible in some of the public dynamics. And so this is what I've done for the last 4 years. Shorthand is, really studied, well, if we're going to fix the problem, what are the factors that went in there? So in addition to deal size increasing, a lot of market making and retail brokerage, which back in the 90s when I worked for my 4 companies, these were the factors that were out there selling. They were part of your sales force that sold your stock for you. And they don't work in the same way anymore. Brokerage doesn't work that way. You're not getting paid on a 25 cents a share trade anymore. They're pennies a share, or even fractions of a penny, with E-Trade and stock trade and electronic trading. That dynamic changed. So now you have to trade large amounts of stock in order to put the same amount of bread on the table. So if you're a small cap company, there's going to be less interest in trading your smaller issue, and perhaps the panelists can help explain that. So as a company, you really need to understand that, and you need to know that you have to be responsible for your own marketing of your own shares. So just like you would never put a product out there without sales and marketing, you can't put your financial products out there without sales and marketing. So that's what investor relations is. That's been my job, so it's easier for me to notice that up front. Also, sell-side analysts, the support for small and mid-cap stocks isn't there like it used to be. So I use that profoundly all through the 90s to help make people aware of your stocks. Stocks are very complex instruments. You really have to understand what a company's doing. It's much easier to understand a soundbite like Facebook or Twitter, or you're familiar with it. It has a consumer brand. Rosetta Stone and OpenTable came out in 2009, one of the worst markets. They were consumer brands, and you continue to see how consumer brands tend to do better than some of the more complex companies. So if yours is more technology oriented, you're going to need a little bit more sales and marketing, and you have to take that seriously to heart. We've already discussed electronic trading, the 4 horsemen, investment banks. In the early 90s, most of my companies went public using Robertson Stevens, Montgomery Securities, Hambrecht and Quist, right, and then Alex Brand, which was in Baltimore, where I moved from 3 years ago. And so those banks consolidated and disappeared, and they were smaller. They worked with smaller deals when they left. Also, that may have had a factor to do with, larger banks now also needed larger deals because their economics were different. So perhaps. And then also, so many people lost money in the internet bubble. And so, the markets are very emotional and psychological in nature. And so people felt better having a bigger deal if they felt the deal was more mature. We know that it has revenues. So none of the companies until, I don't think, all through the 90s, I only worked for one company that actually had real revenues, and they were public long before they actually had real revenues and real profits. We certainly can't do that anymore. And some of them have become really great companies now. And then, of course, the regulatory costs, accounting standards, and Sarbox. People blame that a lot, but we may hear from our panelists tonight that their experience is, yes, it's a pain, yes, it's more expensive, but perhaps it wasn't the block that people think it is. So with that, let's come to the panelists now.
Well, there's one thing that, there's one thing that people never talk about when they talk about the death of the IPO market. And we don't have anybody new because we're not in New York or Boston or anyone on the panel from the institutional buy side. But that world's changed a lot. It's very important to understand that. Years ago, you used to sell IPOs to Fidelity and T. Rowe. Used to sell IPOs to Fidelity and T. Rowe Price, and basically long-only mutual funds that had billions and billions of assets. Today, most of those deals are placed with hedge funds, as you can attest to, which are very high-velocity traders that demand instant liquidity. They're not buy and hold people at all, unless you consider buy at 9 o'clock and sell at 9:15, buy and hold. So that is turned, it's required, it's actually placed a premium on liquidity. So to have liquidity, you need bigger offerings. You have to have more dollars afloat out there. So smaller companies really get lost in the shuffle. So I think everything that we've talked about, I agree with all this. It's in most of our business slides, frankly, at SharesPost. But the one thing I think we tend to forget in the Valley, because we don't have much institutional buy-side people here, in terms of public buy-side, they tend to be in New York and Boston and those kinds of places. We forget that that structure of that market's changed dramatically. So that's also had an effect. And they all kind of go together.
And it's actually,
So in my company, Equity, that's exactly what we help do, is introduce you to the right investors so that you can actually control the trading of your stock in a much better, stronger way.
yes. So why don't we go to our panelists, so Craig, maybe you'd like to start us off and share your experience with Tesla.
Sure.
Inside the company, and what it was like for you as you were considering your IPO, and then what steps you had to take to prepare, and what it was like how did the company change internally pre and post IPO?
Sure, yeah, I can talk in part on the pre-IPO, in that pre-IPO just came up pretty quick because there was a severe downturn in the car economy in 2008. So Tesla went from being questioned whether it would survive or not to then all of a sudden being a hot IPO candidate in less than a year. So that was nice to see. And one thing I wanted to mention is that as the interest in Tesla IPO was sort of percolating in the press, then all of a sudden there began to be interest by investors in purchasing Tesla stock. And at this time, Second Market had purchased Inside Venture, and now there was a market, and we started getting calls from buyers and sellers, and next thing we know, someone had posted on SharesPost an offer to buy Tesla stock at $9 a share. And it was, all these considerations came up for us, and that might be true for some of you in your late stage. You're thinking the IPO is your next securities event, and in fact the next securities law event on your horizon is how to deal with these potential buys and sells on your stock in the private market, and we'll get to that and how to handle that. But in the context of preparing for the IPO, really the preps began in September of 2009, where the board said this is a go, and so it took about 9 months from when the board said go to when the deal went effective in June 29th of 2010. So it's a lot longer than in the old days when it was 90 days, back in the day, I guess. But now it's 9 months, at least from our experience. So there was a lot of focus at the time when the company decided to file for a public offering on educating the staff and the executives on public communications and what's called pre-filing publicity. The SEC says you cannot communicate, even pre-filing, anything that could resemble what they call an offer. And an offer is much broadly defined than what you commonly think of as an offer. So it can be really anything publicly promoting the company that goes beyond just would you be interested in buying Tesla stock. So we had to scrub the website, for example, for any third-party references to avoid any inadvertent incorporation of any of the content in the website into the prospectus, so things like that. But and I'll just tick off a few more items that had to come up in the connection of planning for the IPO, well beyond just the bake-off. It goes much deeper than that from a legal perspective. There's the letter of intent with the underwriters. There's the timing and the all-hands meeting and all of the chart responsibilities. There's the discussion on how to position the registration statement and how to sell your company to the investment community. There's all this giant headache of something called FINRA and D&O questionnaires, where you have to extract and unearth all possible information from the directors and officers about various things in their lives and their financial dealings with the financial community. There's the auditor's letters. There's looking at potential cheap stock problems, and what was the board thinking when it was granting options at 20 cents 2 years ago, and now you're thinking of going out at 12. Things like that. It just opened up just a whole mountain of legal analysis and financial analysis, and so that was something that, as you know, it's very rigorous now. We're in a new era of disclosure where everything relating to the company and its stock and the products and the officers and the directors is now a matter of public disclosure. And so the final thing I'll say is that the company, in the later stages of the offering, has to adopt a whole raft of new compliance policies. There's insider trading and Section 16 policies. There is a code of business conduct. There's a code of ethics for all the business executives and the senior finance professionals. And there's a whistleblower policy, and the board has to be recast into audit committees and governance committee and nominating committee, and there's charters and analysis of directors' independence and things like that, loan restrictions, and it just goes on and on and on. So in hindsight, it was a great experience. It did not really impact the operations of Tesla. A lot of this was behind the scenes, and the engineers continue to build a great product there. But the legal and the finance department were, put through the ringer, as is every company that goes public.
And is there anything that you could have done prior to that to kind of plan along? So if, members of our audience are considering this now, are there things that they can be doing now or should be doing now as they build their websites that you had to scrub, or, so that they, it's like you're building the house with plumbing in it rather than having to come back and put the plumbing in later, which is usually more expensive.
Yeah, for the most part, it's the board tends to watch, or they should be watching, for those issues that are going to surface 2 years later, particularly the cheap stock problems that can derail an offering. They can start building like a philosophy of compensation, so when it comes time to write the description of the compensation philosophy in the registration statement, you're not just winging it, you're making up something. You actually do have a philosophy on compensating your executives, and you can explain the compensation for all the execs. So those would be a couple of examples.
Excellent, thank you. So, Glenn, we'd love to hear about your 9 IPOs, and obviously you have some great experiences. You can tell us what are the success factors, which companies you had great experiences with, and what could our audience members be doing to plan properly and see, is their company, timed well for it now? At what point should they be considering this? We'd love to hear your advice.
Sure. Thanks, Mona. So, my firm, GGV Capital, we invest in both the U.S. and in China, which is where I'm headed tonight on a red eye. So, as Mona mentioned, we've been fortunate enough to work with some great companies and have had 9 of those companies list in public markets over the past 18 months or so. And 6 of those companies are Chinese companies, 3 are U.S. businesses. Most of the listings are in the U.S., New York, and NASDAQ. Stock exchanges, we have 1 in Hong Kong out of that group of 9, and 1 locally in China, in the China markets. So have that diversity of experience from which to draw. In thinking about, is my company ready? Because I know a lot of you are executives at private companies that are growing and thinking about what steps to take to either prepare for an IPO or even potentially entertain other options. I would advise that you all go read my blog, where Sand Hill Road meets Wall Street. I actually did a post on this topic that a couple months back entitled "The Myth of the $100 Million Revenue Milestone." Way back when I was a junior banker at Goldman Sachs, I was inculcated with the logic that the rules were you had to be $100 million in revenue to go public, and you had to be profitable for at least 2 quarters. That was the gospel, and I took that on faith. And what I've come to realize over time is that I think those are outdated and not all that helpful. And so in this post, I created what I call the Fab Four. And those 4 items are, do you have predictability and visibility in your business? Are you operating in a market that's very large, where you can grow rapidly for a long period of time? 3, is the management team of a quality that can be a public company? And that's just not one person. The management team is a collection of people, in all the functional areas that matter when you're public, including, finance, accounting, legal, very important parts of that. And then 4th, is the competitive environment such that you're kind of leading back to point 1, the predictability and visibility you have in your business, is it likely to be to remain that way, or is competition so severe, and are there risks out there that could really change the prospects of your business? If you feel good about all those 4 things, I conclude, you're a good candidate to be a public company. And what Mike mentioned earlier, I think, is a good point. And I would add to it that I think the options available to you as a CEO or management team of a private company that's growing have widened. Another reason why you see less small company IPOs, there might be less demand, there's also more supply of capital. And so $50 million venture rounds used to be, one every blue moon. Now, you open TechCrunch and you pretty much see one every day. So there's plenty of capital available in the private market. And that's another reason why you see less companies opting to go public until later. But if you have those 4 components in my mind, you're a suitable candidate to be a public company. And the real question then becomes, should we do it? Do the benefits outweigh the costs? And there are costs. Craig referred to some of those. But there are also some significant benefits to being public. Some of the typical costs I hear people talk about, the SOX, and sort of compliance costs, they're real. But I would argue that in many cases, they're kind of good business practice sorts of things that you should be doing anyway as you scale your business. Maybe you'd argue with that. I hear things like it's distracting to be public. Once you go public, your employees start watching the stock price and, can get easily distracted. And, for those of you who are running small companies, I think you know that there are lots of things that distract employees, and public stock price is just yet another of those. And far more important to managing those distractions is how you manage your business. And so I don't really think of those as insurmountable costs. There are others, board independence and the like, that some people don't want to cross. But in the benefits, having a public security gives you the opportunity to play offense, be aggressive with your stock, go acquire companies more easily than it would be if you were private. There's a lot of notoriety that comes from being public, and in some businesses that's very helpful. So. We've been fortunate, we've had a lot of IPOs, and in general, I think if you go poll the CEOs of most of the GGV portfolio companies that have now gone public, the overwhelming majority would say they're glad they did it.
Excellent. So that brings up a good point that I forgot to mention, because our title for tonight is Best Options for Growth Capital. So IPOs really serve 2 functions. One is to provide the cheapest source of growth capital into the company, or at least it used to be that way. I don't know if that's truly the case, but it's the best way and the cheapest source of capital. But also it offers liquidity. So if we are moving that liquidity bar further and further down, so we're not looking at 5 years, but we're looking at sometimes 9, 10, 12 years or more, where are other opportunities for liquidity to come in? So this brings us to Mike. So Mike, I'd love to hear you also talk about your experience with IPOs prior to SharesPost, and perhaps that can lead you into why you think SharesPost is serving an important function now.
Sure. Well, I did a lot of IPOs in the early and mid-90s, through the late 90s actually. And so it was a very open market. You have to remember also the macro environment that we were living in was a lot better than it is today. So the economy in the U.S. was incredibly strong. We were running surpluses, we were growing at amazing rates, and the world was good. People bought from startups, companies grew at 30%, it was our birthright, and things felt pretty good, so we had a lot of exits. So you have to keep that in mind. One reason, people bought a lot of IPOs in those days, this is a secret I'll give you right now, the institutions, because the stocks went up. That's why they kept buying them. They made a lot of money buying those things, and then all of a sudden we didn't, and we had a major correction. People woke up and realized we'd taken a lot of speculative companies public. The buy side felt betrayed, they were losing money, and so they shut the tap off, and then the economy wasn't doing nearly as well, and frankly hasn't done as well since. So we've been through a couple of what looked like false starts. The IPO market might pick up again and fell down, and pick up again and fell down, and so we are where we are today, and that's right. It's one of the many reasons why it takes so much longer for companies to get out. But certainly over the years, smaller and smaller companies were able to sell earlier and earlier into their life cycle. And I can remember a banker that I worked for basically saying that the way to think about it was that the public markets would periodically drift into really private company land. They would take more sort of venture kinds of risks, and then periodically they would get out of that. And what he meant was that they would just take certain companies public at an earlier point in their business model. I agree with Glenn. I think you really do have to have those few things, which is a lot of visibility in your business. The model's got to be going, because the worst thing, worse than being private and being illiquid, is being public and being a stock no one cares about. It's actually worse than being private. At least when you're private and you have a hiccup in your business, you can focus internally and fix it and not worry about the next 90 days and dread that earnings call, so you can get beaten up again by the analysts in the stock market, just reminding you that you haven't turned the company around in 90 days. So you really do want to take that on and be very comfortable. Once you get there, and all companies have their ups and downs, but it is important to remember that a lot of great companies are private and stay private, and there are, there's plenty of capital for companies that want to stay private for a whole variety of reasons, whether it's the legal regime that you have to live in today, which is definitely tougher than it used to be, and the liability that officers take on. To the other point of being so short-term focused, I think people really forget how incredibly short-term focused we've become in this country. And if I go back to, it's not just the every 90 days of reporting as a public company, it's because, part of that's because, again, the money that owns those stocks gets measured on a very, very short time horizon as well. So these big hedge funds, if they don't make money every 90 days, their LPs pull their money. Glenn's money is good for 10 years. The guys who buy the IPO, their money's good for 90 days. So you can be the biggest hedge fund in the world one day, and 3 months later you're scrapping for money because you got people running for the door. So that's driven a lot of behavior in the public markets, and it's forced you as public company executives to deal with that phenomenon. And it's really different. I think it's actually one of the biggest problems we have with the public capital markets in the U.S. today, is just that piece of it. I mean, Glenn would never think about going to his LPs and say, well, we had a really bad 90 days, and guys could actually pull their capital. You've had, I'm sure, many companies that went through very tough times and ended up being fantastic IPOs or M&A transactions or great exits and built real businesses, but they had tough periods along the way. So we are in a really, really short-term focused public market, and that's something to consider, and I think that's why visibility is so important. What are some of the alternatives? You don't have to go public to get access to capital. There's a lot of money in the venture market. Notwithstanding the numbers that you saw and the drop-off of IPOs, fundraising's actually come back, and certain segments of the capital markets, people are able to raise funds, and it's not all just A-round investors, it's later stage investors as well. So there's plenty of private capital there. And over time, awful lot of intelligence has transferred to the buy side, and I think investors have become more and more and more sophisticated about technology, and executives have become more and more sophisticated about how to raise capital and how to pitch their businesses to investors to talk about the market opportunity and the growth opportunity and why you should put your capital with us. So what we've tried to do is find a place where those buyers and sellers can come together in a more efficient way, where the transaction costs are lower and where companies have more options as to when they take capital and how they do it, and employees have the ability, if they want, to sell a little bit of stock along the way, rather than joining a startup and then waiting 8 or 9, 10 years for the exit. I think the basic contract with entrepreneurs in Silicon Valley that worked really well when you saw those bars going up was come and join, take a relatively small salary, take a big slug of stock, and we'll get it public in 4 years and we're all gonna be very happy. Well, those days are over, so something has to replace that, otherwise people will stop taking the risks of being entrepreneurs. We are one of many solutions. We're a private capital market. We allow shareholders to post their shares. That can be secondary sales, which is what you hear most about, some employee who wants to sell their Facebook shares. They post it on Shares Post, and we have buyers who come in who are all accredited investors, and they can buy those shares and create liquidity. But it can also be companies.
Is this done automatically online, or do you have?
It's done online with the help of offline brokers. So it's a securities compliant transaction. We're all very well steeped in the securities laws. We understand them. We've all been in the industry for a long time. They sort of meet online and transact more or less online, but there are brokers that help the transaction along, and we have escrow agents and things to hold shares and hold the dollars until the transaction is consummated, generally after a company allows the right of first refusal to pass. But it's also a place for companies to show up and raise capital. So we are in the market right now with a fantastic private company that's raising what I think will be their last round of financing. They are starting to have business model visibility. One of the beauties of having companies go public later is that they have tens of millions and sometimes 100